At the start of 2026, Strategy owed $300 million a year in dividends. By June 2026, that number is $1.7 billion. Same company, almost 6 times more obligations in 6 months. Saylor kept buying Bitcoin by issuing preferred stock, but every share he issued also creates new dividends to be paid. Do that long enough, the instrument that bought the Bitcoin starts eating the company alive. Right now, Strategy has less than 10 months of reserves left to keep paying. After that, the math changes. The preferred stock Saylor uses to buy Bitcoin is called STRC. Here is how it works. Strategy issues STRC shares at $100 each. Investors buy them for the monthly dividend. Saylor takes the cash and buys Bitcoin. Bitcoin goes up, STRC stays near $100, Saylor issues more, buys more Bitcoin. That is the machine running normally. Think of it like buying a property with a loan. You put in some of your own money. You borrow the rest from investors who want a fixed monthly return. The property rises, you refinance, you buy another one. Strategy did exactly the same thing, except instead of a property, it bought Bitcoin. Right now, STRC is at $80.84. That is 19% below where it was issued. When it drops below $100, Strategy cannot issue new shares without taking a loss. The capital channel closes. No new STRC means no new cash. No new cash means no new Bitcoin. But here is the part that stopped me. STRC is not even the worst one right now. Strategy has an older preferred stock called STRK. It pays a fixed 8% dividend. It was issued at $80. It is now at $55.46. Two preferred stocks significantly off their target price at the same time. The machine does not have one problem, it has two. And the person running the machine just made a move he said he was going to make 3 weeks before he made it. On May 5, 2026, Michael Saylor held his Q1 earnings call. He said on the record, "We will probably sell some Bitcoin to pay a dividend just to inoculate the market and send the message that we did it." I read that sentence 3 times before I moved on. He chose the word inoculate. Think of it like a flu shot. You give yourself a small dose of something uncomfortable now so your body learns not to panic when it happens later. Saylor was saying, sell a tiny amount of Bitcoin today so investors are not shocked when it happens at a larger scale down the road. 6 days later, on May 11, he sat down with CoinDesk. He called potential Bitcoin sales inconsequential. Then between May 26 and May 23rd, he sold exactly 32 Bitcoins for $2.5 million. The smallest amount imaginable for a company holding 847,363 coins. The first Bitcoin strategy has sold since 2022. On June 1st, he posted publicly, "Our goal is to make STRC the best credit instrument in the world." 4 days later, on June 5th, he went on television and explained the math. Selling 32 Bitcoin to fund dividends is accretive. If you then raise enough capital to buy 320 to 640 BTC, Bitcoin per share increases. And then on June 21st, with STRC at its lowest price on record, he posted the orange dots chart. Every Bitcoin purchase strategy has made plotted on a price chart. His caption, "Looks better with more dots." That is the signal he posts before a new purchase. Let us look at what Saylor actually did. He announced a sale 3 weeks before he made it. He sold the minimum. And the same week his preferred stock hit its worst level ever, he posted a buy signal. The man who called that sale a deliberate message is the same man who cannot stop buying regardless of what the preferred stock is saying. That sequence tells you a lot about how he runs this. But it still does not give you the number that actually decides whether this works. Strategy publishes a metric called BTC Yield. For 2026 so far, that number is 11.8%. Bitcoin per diluted share has grown 11.8% this year. That is the headline. Here is what it does not include. Every time Strategy issues STRC at 11.5% to raise $1 billion, it creates $150 million in annual dividend payments. That obligation does not go away. It sits on the books every year drawing down cash. BTC Yield counts the Bitcoin. It does not subtract the per share annual cost of the dividends used to fund it. This missing number has a name: net BTC Yield. Bitcoin per share growth minus the annualized per share preferred dividend cost that generated it. That number exists. Strategy can calculate it, but no filing publishes it. No analyst covers it as a standard metric. A company can report 11.8% BTC yield while its dividend coverage falls from 7 years to less than 10 months. Both can be true at the same time. The metrics show you one side. The reserves show you the other. For anyone holding MSTR stock right now, this is the number your investment thesis is missing. You are being handed a scoreboard. It is accurate, and it shows you half the game. The number Strategy does not hand you is the one that tells you how fast the runway is actually shrinking. You now know the number Strategy publishes and the number it does not. Which one do you think actually tells you whether this machine is sustainable? Tell me below. And if this breakdown is useful, give it a like so it reaches the next person watching this. Right now, MSTR looks like a death spiral, and every investor who bought it seems stupid. But there is a bull case for this stock that you need to know as well. Strategy survived 2022. Bitcoin fell to $16,000 per coin. At the lowest point, MSTR's total debt exceeded the value of its Bitcoin and cash by $300 million. Bankruptcy was predicted widely in the financial press. But Saylor did not sell a single Bitcoin. He raised equity throughout the drawdown. He kept buying. Bitcoin recovered above $100,000 by late 2024. The company went from a $300 million hole to a $48 billion buffer above its obligations. That was 4 years ago. The same conviction through a worse drawdown than this one. There is also this. The MNAV right now is 1.06. MNAV measures how much you are paying for each dollar of Bitcoin per share after all debts and preferred stocks are subtracted. At 1.06, you are paying 6 cents above that net Bitcoin value. At the peak of the 2024 bull run, that same number was above 3. People are paying 3 times the Bitcoin backing for a share of MSTR. The common stock raising program is still open. Strategy has over $25 billion in remaining capacity to issue new shares directly. STRC may be broken as a capital channel. Other channels are not. And the actual liquidation trigger is not a falling Bitcoin price. Think of it like a car loan where the bank can only demand repayment if you stop making payments entirely. They cannot take the car because its value dropped. Strategy's convertible debt works the same way. No matter how far Bitcoin falls, the lenders cannot force a sale. Strategy would only be forced to sell Bitcoin if cash runs out completely. For that to happen, Bitcoin would need to fall around $26,200 per coin. That is more than 50% below where it is today. I want to be fair. The 2022 survival is real. The floor at $26,200 is real. If Bitcoin recovers to $100,000, the math reverses fast and STRC reprices back toward $100 on its own. But survival in 2022 required unlimited time. In 2026, there is a clock, and that clock was not there before. In May 2022, a project called Terra Luna held a $2.3 billion Bitcoin reserve, set aside to defend the peg on its dollar-linked token. When the peg broke, they deployed it. The reserve lasted 5 days. By May 15, 2022, 90% of the market cap was gone. $40 billion erased in 7 days. Harvard Law published a paper on exactly what happened. The key finding: in a fast-moving collapse, the speed of the spiral outpaces the reserve. Reserve size does not determine the outcome. The speed of confidence movement does. Now, strategy is different from Terra Luna, and this difference matters. Strategy can choose whether to pay the STRC dividend each month. It is a decision a person makes. Terra Luna had no such choice. Its system was controlled by code. When the peg broke, the code kept running automatically. Nobody could press pause. Strategy has a pause button. Terra did not. But the pattern underneath works the same way. Bitcoin falls, STRC falls, the cost of raising new capital rises. Dividend coverage shrinks. More pressure on Bitcoin. The question is whether less than 10 months of runway is enough for Bitcoin to recover before the reserve runs dry. There is one more mechanism most people are not tracking. The two leverage ETFs that follow MSTR, MSTU with $3 billion in assets and MSTX with $1.8 billion, have each lost about 95% of their value over the past year. MSTR itself closed at $94.13 on June 24, 2026, down 75% from a year ago. Those ETFs rebalance every single day. During a drawdown, that daily rebalancing mechanically requires selling MSTR. Not because of any view on fundamentals, because the math of daily rebalancing demands it. On the days MSTR falls, $4.8 billion of structured product adds selling pressure from its own structure. On June 23, 2026, CryptoQuant published a public call for strategy to halt all Bitcoin purchases. They said, rebuild cash reserves to $2.8 billion before buying again. There is 24 months of coverage. The first major on-chain analytics firm to say this out loud. After doing this research, I'm not worried about whether Bitcoin could recover, because I know Bitcoin recovers every cycle. I am left with a question about whether the instrument that bought 840,000 coins can hold together long enough for a recovery to matter. Here are 3 things to watch. 1. STRC relative to $95. CryptoQuant says recovery above $95 is what reopens the preferred issuers window. The machine restarts. 2. The next 8K founding. 132 BTC sale was a message. A second sale above 1,000 coins is a different signal entirely. 3. The weekly ATM report. Every week, Strategy files a document showing how many new common shares it sold and how much cash it raised. If that weekly number falls below $100 million, the fallback capital channel is weakening. The machine that built the largest Bitcoin treasury in history created $1.7 billion in annual obligations that now build the same treasury every month. Time is the variable neither side controls. A few days ago, I covered a company where a $7 billion catalyst just landed and the CEO can now buy its own stock at half price. Shareholders are getting direct benefits from it. This is a time-sensitive window and it is closing. Click here to watch that video now.